What's going on, you guys? This is Shiraz Ahmed coming at you with some more financial and business content. In today's video, I wanted to go over a really important topic, which is tax-free savings accounts. And if you're one of the millions of Canadians who are utilizing this account, this is a video you're going to want to check out. So stay tuned. Okay, for those of you who don't already know who I am, my name is Shiraz Ahmed. I am a financial advisor and associate portfolio manager with Sartorial Wealth of Raymond James, located in Toronto, Canada. As a cross-border advisor, I work with families across North America. So today I wanted to go over really important factors about tax-free savings accounts, a lot of misconceptions about what it is, and frankly, the best way to integrate this into your portfolio or as part of your portfolio. And of course, as a reminder, if you guys appreciate the content that I'm creating, if you could please smash that like and subscribe button, as it does help the algorithm pick up creators like me. And of course, I'll be uploading new content every single week. So please do hit that bell icon so you'll be notified the next time I upload. So let's jump in. Okay, tax-free savings accounts. What are they? Well, for starters, I would say that it's probably misnamed. I don't know why the Canadian government decided to call it this, but it's actually not a savings account. And this is probably the number one myth that people have about tax-free savings accounts. They're not a savings account whatsoever. In fact, it is a self-directed investment account where you have the ability to buy all kinds of investments inside of it. But the cool part is that it has a tax attribute. So unlike its counterpart, the RRSP, which I'll get into in another video, the unique part about a tax-free savings account is that it actually is exempt from paying taxes, which is one of the major features and benefits, which I'll get into a little bit further. But unlike an RRSP, which is its counterpart, it is unfortunately not giving you a tax incentive in that specific year. So you're using post-tax dollars ultimately. But again, I'm digressing. We'll get into all the salient features and benefits in a minute, but really big picture, it is an investment account. So really it should be named tax-free investment account. So it was really brought in to the equation in 2009. So if you were over the age of 18, you are allowed to participate in this investment account. And again, you are contributing post-tax dollars and hoping to invest for your long-term growth using this account and ultimately not having to pay tax on what you earn. So it was created in 2009 as a way for Canadians to actually augment their long-term savings plans. Traditionally, we had used RRSPs. Some people had pensions with their employer, defined contribution or defined benefits. And unfortunately, those are becoming less and less prevalent these days. So in 2009, the government introduced a new program called a tax-free savings account as another method to be able to invest for your long term and effectively giving Canadians a break on the taxes that would be potentially generated inside of this investment account. Okay, so let's jump into how it works, all right? So for lack of a better word, you need to open up an investment account. So with any securities dealer or any investment dealer, you should be able to open up a tax-free savings account. Outside of the general paperwork and whatnot that everybody needs to go through, and these days things are getting better and more electronic, but you have to open up the account. Step two is then effectively funding it. Now, the interesting part about the tax-free savings account is, again, you're using post-tax dollars. So the money that you put in, you don't get a credit in that given tax year. Okay, so that's an important distinction that it has, unlike the RSP, which you do get a tax incentive. The cool part about the TFSA is that it's not even a tax deferral program. It is tax exempt, which is a very important distinction. Exempt means you never have to pay taxes on the income or the gains that you have inside of it. Unlike an RSP, where you're basically just pushing it into the future under the hopes that your tax bracket will be lower when you retire. So it is a hugely powerful feature that you are completely tax exempt. So how much can you put in? Well, as of 2020, the amount that you can put in, assuming you were over the age of 18 when this was created back in 2009, is actually $69,500, which is a pretty significant amount of money for you to be able to shelter from taxes. So it's a hugely powerful vehicle, but for 2020, this year alone, you can actually put away $6,000 in post-tax dollars that you could put into the TFSA and then help compound and grow for your future. Again, I can't stress enough, tax exempt account. not deferral. So that's a huge distinction that we need to make here. Okay, ultimately, how do I use it, or how does it fit into the grand scheme of things? Well, again, unlike the RSP, which is really designed purely for retirement, this actually can be accessed pre-retirement. There is no penalty for pulling your money out of a TFSA. However, there should be a star beside that statement, simply because if you take money out in a specific tax year, you cannot recontribute it back in unless you have space for it. So let's say you had maxed out $69,500 this year and you took it all out because you had to pay
some random bill,
and then now you want to recontribute it back again. Well, you actually have to wait until the next calendar year to recontribute the funds back, because it looks as though you would actually have gone over your limit. So you have to be really careful about it, and the penalties can be actually pretty severe. So I'd really encourage you to make sure that you're in line. Every single year on your notice of assessment, when you file your taxes, you'll actually get a notice as to how much your allowable room will be, just like you would for the RSP as well. So I would encourage you to check that out prior to actually investing any of your funds. Another really important question that we get all the time is this better than an RSP? Well, they're basically apples and oranges. Like, they're really important, and you should frankly be utilizing both. As a professional advisor, and in some of the planning that we do with our clients, we actually suggest looking at a spillover method. And a lot of it is relative to how much income that you have in a given year. So RSPs are a great tool for actually lowering your taxable income. If, for example, you are a salaried employee or a T4 employee, there are actually very few ways to lower your taxable burden if you're just a salaried employee, unlike, let's say, a business owner for that matter. So if you have a high salaried income, you may actually want to look at maximizing your deferral inside of the RSP in addition to your TFSA. But don't leave the TFSA hanging. It is such an important tool. You can shelter a lot of money in it, and on top of that, you can access it a little bit easier as well, in that there are no penalties or costs for withdrawing it, other than some, very high level administrative, depending on your investment firm. So it is a hugely powerful tool. I highly, highly recommend people maximize your investment strategy inside of it. Again, you are exempt from paying taxes. So because you're exempt, again, I don't want to tell people or give advice on how you should be investing your funds. Frankly, that's about suitability and what's best for you and your family and what your goals and objectives are. But realistically, because you're exempt from taxes, a lot of people, especially at certain institutions, put them in some really, really low rate of return type solutions, which may or may not be the right fit. Again, if you're risk averse, maybe that's the perfect thing for you. I don't know. But in general, because you're exempt from paying capital gains or frankly any taxes inside the account, if you are ever going to swing the bat, this is the one where you do it. And at least this is the type of account. So if you're looking at what we call asset location, as in what specific account that you actually have your investments in, this is a good one to have some of your torquier investments, frankly, just because, again, you're exempt from some of the taxes that come with it. Or you could actually even consider looking at this as some of your, to shelter some of your income generating investments as well. Again, because of the fact that you're not having to pay taxes on it, it's not so bad. Big picture, that's kind of the major salient points about a TFSA. There's a lot more out there, and I would encourage you, if you haven't already looked at maximizing this account, please do so. Contact your local investment dealer or financial advisor or whoever you deal with. Make sure that you're taking advantage of this account if you're over the age of 18 and you're a Canadian resident and a Canadian person. If you're an American, check out this video where I kind of talk about how that's not a good idea. So if you're a US person living in Canada, sorry, this is not the best vehicle for you because of its tax exempt status or lack thereof in the US. So please don't hesitate to let me know if there's anything else you guys want me to cover. That's actually one of the best ways in which I can give you the content that you, the viewers, want. So until next time, I appreciate the support. Please smash that like and subscribe button, and we'll talk to you guys soon. Bye for now.